Hello and welcome to our video presentation. We're here to analyse and discuss the hotel industry. In particular, we're going to compare the strategies used by the Hilton Worldwide and Starwood Hotels and Resort. Founded in 1919 by Conrad Hilton in City, Texas, the Hilton Hotel Group has had an interesting rise to power where it now represents a global market share of 4.5%. In 2007, Hilton were acquired for a mega $26 billion by Blackstone Group. They operate within the mid-scale to high-end luxury sectors within the hotel industry, with a diverse brand portfolio including the world-famous Hilton Hotels and Resorts and other popular chains such as the Conrad and Waldorf Astoria. They currently own or manage over 4,000 hotels in 91 countries. Starwood is a relatively new hotel chain in comparison to Hilton Worldwide, but are in no way a small fish playing in a big ocean. Created in the 1980s, they committed a series of high-profile acquisitions such as the West End Hotels and Resorts and ITT Sheraton Corporation. That moved Starwood quickly into contention with the super players in the hotel industry. In a similar fashion to the Hilton Worldwide, Starwood Hotels and Resorts also operate in the mid-scale to high-end luxury sector with 1,270 hotels in over 100 countries. The hotel industry has been growing in size since 2009, and the global hotel industry revenue is expected to reach $550 billion in 2016. An industry which has contributed $7 trillion to the global economy in 2013 is certainly a profitable one. We are going to analyse the industry as a whole and show how profitable it is, how easy it is to join, and what the plans for the future are. Demand growth is one of the main factors driving the industry evolution. More and more people are travelling each year, meaning the need for the hotel industry is continually rising. However, people's needs and wants always change, therefore hoteliers need to constantly be able to adapt to people's needs and wants. What a hotel offers has constantly changed through the years as people expect more and more. The concept of the Grand Hotel launched the rise of hotels. These were iconic and symbols of nations. 1960 came around and so did Conrad Hilton, who decided to export his hotel idea worldwide in a bid to fight off communism. However, in order to enter the global market, hotels would have to dispose of their nationalistic identities and uniqueness. For 20 years, the consumer was fed up with the impersonality offered by hotels and once again desired uniqueness and personality. These monumental shifts had led to various hotel groups falling short of the mark, yet others have continued to thrive. Grant 2010 stated that a big drive for the industry life cycle is knowledge. The services that were offered 100 years ago are completely different to what we expect today. Hotel groups are constantly searching for new and improved ways to offer their guests the best experience while trying to differentiate themselves from their competition. Johnson 2014 correctly describes the attractiveness of an industry by how easy it is for participating firms to earn high profits. The Porter's Five Forces framework helps us to identify the attractiveness of an industry. Not all hotel groups are the same, as they operate in different strategic groups and target specific segments of the market. Therefore, not all hotels are in direct competition. Low differentiation is a major source of rivalry, as there isn't a lot to stop customers switching between hotels. However, hotels are trying to differentiate themselves with the rise of well-known hotel restaurants and cocktail bars. High fixed costs due to hotels frequently being placed in metropolitan areas mean hotels on a whole have to cover certain costs. This forces hotels to compete against each other when it comes to offering deals during the low season or offering loyalty schemes, which is prominent with higher-end hotels to ensure customer loyalty and retention. There are considerable scales of economy for players trying to enter the hotel industry. Finding a suitable location to place a hotel in a metro area is a key success factor. However, there is a limited supply of suitable locations, and when location is found, it is extremely expensive to create a new hotel. This means that new entrants will be deterred against trying to enter the hotel industry, as it is unlikely they will make a profit.
Political factors affecting hotels. Acts of terrorism can have a severe impact on the profit margins of a hotel. Political instability means people are less likely to stay at hotels due to feeling insecure about what might happen to their safety and well-being. Economic factors affecting hotels. Financial crashes within the economy affect consumers spending heavily on luxury services. People look to save for a rainy day, so they look for cheaper alternatives such as staying at Ibis. Technological factors affecting hotels. Technology continues to rise and develop fast within this generation. Airbnbs have now been introduced to the market. It affects cheaper hotels as consumers can now enjoy a better experience for a cheaper price. However, it doesn't really bother higher-end hotels as their service cannot really be matched.
Grant states strategic group analysis is very useful in identifying strategic niches within an industry and the strategic positioning of different firms, whilst Ireland et al. Stresses that the competition between firms within a strategic group is greater than the competition between a member of a strategic group and companies outside of that group. Due to the fragmented nature of the hotel industry, it is evident to see how certain hotel chains only operate in particular strategic groups, whilst others attempt to play in almost every group. As previously mentioned, with the strategic groups, it is hard to compare groups that are not in the same group as each other. Therefore, we have broken down our hotel chains and selected particular hotels in both groups who will operate in the same groups, and we will then compare them. The Waldorf Astoria has 26 hotels in its portfolio, but that is dwarfed by the 33 hotels in the St. Regis range. Whilst they both have hotels in the busiest and most iconic areas, which is a threshold capability in the luxury hotel business, it is the St. Regis who are striving to create a big difference between themselves and their competition. Johnson et al. Describes threshold capabilities as being those needed for an organisation to meet the necessary requirements to compete in a given market and achieve parity with competitors. However, it is the St. Regis Hotel and Resort Group who is striving to ensure long-term success by changing their focus and adapting to the changing environments. In the following 10 years, the St. Regis plans to open an outstanding 25 new hotels and resorts, with 11 of them being in China. This is due to the recent rise of Chinese billionaires. With the rise of the Chinese super-rich, luxury brands are flocking to China to reap the benefits, and the St. Regis have outmaneuvered the Waldorf Astoria, who only plan to open 9 hotels worldwide and a meagre 3 in China. The Hilton Hotel was the first hotel group way back in 1954 to create a central reservation system called Hilton. This helped them to stand out from the rest and was widely respected action in the hotel industry. Other hotels soon imitated this model, and it soon became a threshold capability within the hotel industry. So it was up to Hilton once again to ensure their competitive advantage and create a new system. In 1997, the Hilton Hotel Group made an alliance and brought the 2 Hilton hotels back together for the first time in over 32 years. They realised that they needed to advance their central reservation system, so they rolled out a new system, Hillstar, which ensured Hilton's hotels stay above their competitors. Leicester, 2011, proved that once again, Hilton Worldwide is always able to stay ahead of the market in terms of technology. They launched a program called the Honours Reward Exchange, which allows their loyal members to exchange hotel points for air miles and vice versa, which helped Hilton Worldwide solidify their place as a leader in innovation. Whilst the Hilton Honours Reward Program offers hotel customers a better return on their investment when staying in their hotels, Starwood have combined their reward scheme to offer payback for its credit card points scheme, making it a more lucrative offer.
The McKinsey & Co. consulting company developed a framework for assessing the degree to which the various elements of an organization's design fit together in a mutually supporting manner. This framework allows us to internally analyze the organizations and ensure that elements are aligned in order to achieve organizational objectives. Both Hilton and Starwood are similar in design and structure, as they are direct competitors in the same industry. However, Hilton's competitive advantage is that they leverage their innovation leadership in the industry, while Starwood's leverage unique design.
According to Potters, a value chain is a set of activities that an organization carries out to create values for its customers. Lynch suggests that the value chain analysis involves the linkage of 2 areas, linking the value of industry's activities with its main functional parts and assisting the contribution of each part in the overall value added to the business. Hilton focuses on both their primary and supportive activities. For an example, the procurement supports both the primary activities and the human resource management. In regards to Starwood's operations, focuses more on consumer relations and bookings.
Return on capital employed. Looking at the ratios above, we can see a large difference in results, but one thing they do have in common is steady growth over the last 2 years. This would not have been as apparent without investment. One of the reasons for the lower ratio of the Hilton is that they have a much bigger cash reserve in form of a parent company in comparison to Starwood. The gearing ratio. An acceptable gearing ratio has no constant determinant. It's based around the industry average. Generally, the higher the ratio, the more likely to suffer when the downturn of the business cycle occurs. This is because the debt they have still needs to be serviced, despite potential lack in sales. The average gearing ratio in the hotel and leisure industry Q4 2014 was 1.54. The ratio for both the hotels exceeds the average. This could be put down to the different hotels operating under the umbrella companies. Hilton is still slightly higher at 2.46. This could be explained by the reformation of the Hilton Worldwide Holdings company very recently. Starwood has been operational under the same name for many years. Operating with a gross margin of 60% plus like the Hilton demonstrates prowess in the industry in which they operate. Operations throughout need to be tight to achieve this result, especially with a small 2% growth. Starwood has a more common margin which has stayed steady over the last few years. This is fair management, but does not suggest growth is a large priority at the current time. Starwood's net profit ratio closely mirrors the gross profit ratio. This shows strong results with little change over the last 2 years. The Hilton have turned around their performance after increasing net margin by over 60%. This change is almost unheard of, but the company manages to continue at this rate and they may be able to take over Starwood in the not too distant future. At the end of 2014, both companies reported similar profits. This shows both strategies employed are working. Market capitalisation is the amount of shares that remain to be sold times the price per share currently. Hilton Group have almost 50% more in terms of revenue to raise via shares. This is an especially strong position to be in as the price of a share in Hilton is only $22.67. This is $46.71 lower than Starwood's most recent closing price of $69.38. This means the Hilton has more opportunities for further investment from existing shareholders to raise further capital for projects up and coming. This graph shows the growth in share price between Hilton and Starwood hotels. As you can see, the Hilton is performing slightly better at present.
As David Aker writes, positioning usually implies a segmentation commitment, an overt decision to ignore large parts of the market and concentrate only on certain segments. One reason this segmentation commitment is necessary is that the needs of different segments are often conflicting in their satisfaction, mutually exclusive. Companies can pursue either a concentrated STP marketing strategy by offering a single brand to only one or two segments, or a differentiated STP marketing strategy in which they strive to capture many different segments by targeting a different brand to each segment. Hotels have segmented the market in terms of travellers, such as business travellers, leisure travellers, group meeting travellers and other travellers, and developed numerous brands in order to suit each segment. Porter's generic strategy emphasises 3 options for businesses: cost leadership, differentiation and focus base. Sheraton by Starwood and Hilton are flagship brands and targeted at the broader audience, therefore they belong in the cost leadership section. Canopy by Hilton and Tribute Portfolio by Starwood offer differentiated, contemporary services and products which are targeted towards the high-earning younger generation, aka the millennial group. Hilton's Hampton Inn, Garden Inn and Starwood's 4 Points belong in the cost focus section as they offer a practical environment for business travellers at a cheaper cost.
On screen you will see a SWOT analysis for both the Hilton and Starwood hotel groups. Following that, there will be a more in-depth SWOT analysis of 2 particular brands operating within these groups.
They outline the positions the hotel groups are currently taking and their opportunities for going forward. As we were conducting our research, there was a major merger between Starwood and the Marriott Hotel Group. This demonstrates the importance of mergers and acquisitions in the hotel industry, and that it is the best method for improving and advancing within the industry.